Welcome, Professor Bertolini and other members of the tax team. Thank you for joining me here today. For those who do not know me, my name is Brian Foley. Today we'll be talking a little bit about the Jones case. I'll be going into a little bit of my research and the conclusions that I came about in this tax matter. So, a little bit of the facts of the case for those of you who may have forgotten. The Jones sisters, Amy, Jane, Janet, Joyce, and Cammie Jones, wish to incorporate their family farm. In doing so, they'll be contributing a few different assets and liabilities to the corporation. There are follows. Farmland that has a fair market value of $1 million and a basis of $700,000. Equipment that has a fair market value of $500,000 and a basis of $300,000. And accounts payable and other loans worth $2 million. After the incorporation, each of the sisters will have 20% control. In addition, Amy Jones has said to me that she would like to contribute a note payable to the company in the amount of the excess liabilities over the assets. The other sisters would be guarantors of this loan. So I found a few different IRS code sections and court cases in my research that will help us in advising our clients. The first is Code Section 351. Code Section 351 says that the general rule is that no gain is recognized from the formation of a corporation as long as the taxpayers have control. This is the case in this situation. The sisters will have control. Therefore, no gain will be recognized on the appreciated assets that are being given to the company. This is great news. Next is Code Section 357. 357 says that the excess of the aggregate liabilities over the contributed assets is a gain to the taxpayers. Unfortunately, this is the case in the situation. We have some underwater assets that are being contributed to the corporation. In this case, there is $1 million in basis of assets contributed, while there is $2 million in loans. The $1 million excess will be a gain to the taxpayers because each of them has a 20% share. They will each of the sisters will have a $200,000 gain. So next, I came up with some ideas for alleviating this gain. Amy had already said that she would like to contribute a note to the corporation in the amount of the excess liabilities over the assets. This would be a great idea. In a court case in 1998, the Ninth Court of U.S. Appeals ruled in Parachi v. Commissioner that a note transferred to a corporation has the basis of its face value. So if Amy contributed this note worth $1 million, which is the excess, then in essence the basis would equal the liabilities and 357 would not apply to the situation. Next thing I looked at is that the sisters are going to be personal guarantors of this loan. I looked at whether this will help them alleviate their gain under Section 357. So I found a court case that was pretty much exactly the same as our situation. It is called Sagerman Farms Incorporated versus the Commissioner. It was ruled in 2002 by the Seventh Court of U.S. Appeals. This case, it was ruled for the Commissioner, and it was found that personal guarantors of loans does not create basis for the taxpayers, and therefore does not shield the taxpayers from the 357C gain. The court's rationale in this was that there was no economic outlay. The guarantors of the loan would not have to pay back the loan really unless there was a default on the loan. So Jane, Janet, Joyce, and Cammie, all being guarantors of the loan, would not be shielded from the 357 gain. So in my recommendations, I would like to recommend that the other sisters also contribute a loan in their share of the proportion of the excess liabilities over the assets. So if each of the sisters could contribute a $200,000 loan to the corporation, they would be shielded from the 357 gain. It's a personal decision for them. The note they would have some risk ramifications if it was not paid. So they would have to look at the risks over the benefits of this. Thank you for joining me today to talk about the Jones case.